So recently I was at the bar with my friends and we were watching the NBA playoffs. During one of the commercial breaks, I had brought up the topic about investing, and I just straight up asked them, like, do you guys invest? Are you guys investing in anything? Like, what are your investments looking like right now? And to my surprise, like, they looked at me with a blank face and they all straight up just told me that they don't invest in anything. They don't have any investments in any stocks or ETFs or any retirement accounts. They didn't even know what a Roth IRA or 401k was. To be honest, that kind of shocked me. I mean, these are guys that are in their early 20s like me. I mean, maybe it's because I've been on the internet a lot and just listening to a bunch of creators on here talk about investing in money. I just figured that everyone knew about this, but apparently not. And I don't blame them too much because, unless you went to school for a finance degree or you had any like finance classes in high school, you probably haven't been taught this anywhere. You're kind of just expected to figure it out yourself, and nobody's really there to hold your hand through it or teach you anything. And this sucks because I think that learning young is super crucial, because investing young is, to me, like how you win the game. Because allowing yourself to invest as early as you can gives you enough time to allow your money to grow and to compound over time. Investing in the stock market, for example, which is like the most popular way to invest, I would say you're looking at long-term returns, right? And I hear this a lot. But over time, the S&P 500 has brought in around an average of 7 to 10% of returns per year. And this isn't indicative of how it's going to do in the future, obviously, but historically, looking in the past, the S&P has been in the green. There's obviously been some years where there were major downturns, like major world wars or the Great Depression or COVID or any of that. But overall, I think most people that stuck around and stayed in the market during those times benefited in the long run, which to me is what this game is all about. Like, you'll see a lot of people talk about day trading and short-term gains and the quick money hacks and stuff. But to me, I think the safest and most proven way to make money in the stock market is to just play the long game. And it's because of this thing called compound interest, compound returns, which some financial scholars would call the eighth wonder of the world. But honestly, it's really simple. Imagine investing a pretty small amount of money every month. So you're looking at your growth after the first month, and you probably don't think it's that impressive, right? You probably don't get that much from it. But over time, if you continue to let that money grow, and if you keep contributing to that investment, over time, that money will keep earning, and your returns will generate more returns. And it'll get to a point where your money begins to work for you. If you're able to consistently put in money every week or every month into the stock market and allow it to continue to grow that way, you'll be setting yourself up for a pretty good future, I would say. And it doesn't have to be that much to start out. I started off putting about $50 to $100 a week from my paycheck into an ETF. And over time, that's brought me a pretty good return. You don't have to have a ton of money to start. You just need to start, period. I remember speaking to an old neighbor of mine before he moved out. He's been retired for a while. Got on the topic of investing as well. And he told me that investing in the stock market made him very wealthy, to the point where he was able to retire and buy a brand new condo on the lake to enjoy the rest of his retirement. And this is something that took years for him to build. He was really patient. He stuck to his plan, and it paid off. So before I give any tips or any experiences I had, I just want to say that this is not financial advice. I am not a financial advisor. I'm just a 24-year-old with a finance degree and who has a little bit of experience in investing. Here's a few things that helped me to start investing, and some things that you can consider as well. So if you're in your late teens and early 20s, you probably don't have a lot of responsibilities or bills growing up and setting up your life. So instead of blowing all that extra cash you get from your paycheck, I would take a bigger portion of that and set it aside to invest. So for me, what I was able to do was I would try to save about half of my paycheck, maybe more if I was able to. And I would use that money to invest. I would put that money into the stock market and use any leftover I had on things that I wanted to buy or things that I needed. And some people might ask, where exactly do I invest? Simply put, there's a few different apps you can use, like Acorns, Robinhood, Charles Schwab, Webull, Fidelity, TD Ameritrade. There's a ton of different apps you can use to get onto the stock market and start investing. I would do your own research and figure out the one that fits your needs the best. So once you're on a platform and you're able to get access to the stock market, the next thing you're probably asking yourself is, what exactly do I invest in? Like, what can I put my money into to allow it to grow? And a lot of people may think to invest in individual companies like Apple, Google, Costco, Walmart. These are all great companies. All of these companies are on the S&P 500 and they're doing really well right now. But you need to keep in mind that some of these stocks although they do perform well, it's not the best idea to put all of your money into one stock. Don't put all of your eggs into one basket. The trick with managing risk in the stock market, because there's always risk in the stock market no matter what, the trick is to diversify your money. And diversifying is a simple way of saying to spread your money across a bunch of different stocks that operate in different industries. And you may think, well, some of these individual stocks cost a lot of money, right? Like, I don't have enough money to buy one full stock of each company in different industries. And for me, what worked was to buy ETFs. This is like a collection of different stocks provided by an investment company that manages these portfolios, that manages these stocks. And basically all they do is to take that money that you put into the ETF and spread it across a bunch of different stocks for you. This is a very easy and very effortless way to diversify your stock portfolio. And a few ETFs that I like and that I personally invest in are VOO, which basically mirrors the S&P 500 entirely. There's also VTI, which covers the entire stock market as a whole. And if you're into tech, for example, QQQ, it's a more tech-heavy ETF. So this ETF invests in companies like NVIDIA, Intel. I believe SanDisk is involved in that as well. But these are some of my favorites because they don't require any effort into diversifying, and they're all passively managed as well. And basically what that means is that the companies that manage these portfolios do it in a way that doesn't require much rebalancing, which basically means they don't have to change the weight of each stock as much as actively managed ETFs, which also means that their expense ratios aren't as high. Because the thing with ETFs is that these companies take a piece of your earnings for themselves as a way to like pay themselves for managing this portfolio for you. And typically passive ETFs don't charge as much as active ETFs because there's not as much work required in managing it. They're not actively changing the weight of each stock as much as actively managed ETFs are. And another thing I want to touch up on are dividends. Dividends are cash that companies pay out to their investors as their share for holding on to the company's stock and as a way to reward investors and to pay them their share of the company's profits. And what I do personally is any dividends that I receive from my stocks, I use to reinvest and to buy more shares of said stock, of the stock that I receive the dividends from. And in this way, I'm able to buy more stock and to get more invested in the companies and to keep my portfolio growing. You can also invest in a dividend ETF like SCHD, which gives you dividends quarterly. And for me, this is a great way to earn passive cash every quarter, since ETFs like these typically have a higher dividend yield than most other stocks. And another way that I like to earn a little extra cash is to take advantage of high yield savings accounts. I think it's an effortless way to earn a little extra money every month just for having your money in the bank. So typical banks typically don't offer much interest every year for savings accounts. I believe the one I have with Chase only gives me about 0.01% a year, which is basically pennies, especially in today's economy. But with an HYSA, you're able to earn a little bit of extra cash for keeping your money in your savings account. And I think that can help give you a little hedge and give you an extra boost against inflation compared to a normal savings account. Because you got to think, if your money is just sitting in your bank account doing nothing, you're basically losing out. You're losing value on it every year. And especially now, recently, with the way that inflation has been going, your dollar doesn't stretch as far as it used to. So you have to find a way to combat that, to fight against that, to hedge against that, as people say in the financial world, to allow yourself more room to just live in this economy. Another thing I would look into is budgeting as well. Budgeting, I think, to me, is probably one of the first things that you should do before you start investing, because you want to give yourself room to invest in the first place. You want to make sure that you're keeping track of how much money you're making, how much money you're spending, and where exactly the money you're spending is going. To me, there's not many things worse than going into your bank account after payday and seeing that half of your paycheck had already gone into expenses or subscriptions that you completely forgot about or don't even need. I would look into your spending habits and look into the things that you're buying each and every week and question yourself and ask yourself if you really need this. Now, I'm also not saying not to enjoy life. There's nothing wrong with getting a bowl of Chipotle or a Jersey Mike sub every now and then. But you also want to give yourself a chance to pay your future self, or to allow your future self to have something to fall back on for retirement. So for me personally, when I look at my budget, I want to make sure that I'm restricting myself from enjoying my life and enjoying the money that I have. But I also want to make sure that I'm not cheaping my future self out just for, a temporary pleasure that I can get right now from whatever it is that I'm looking to buy, whether it's clothes or a new pair of Jordans or a new set of golf clubs. I want to make sure that I have my necessities taken care of as well as my future self taken care of. Now, one thing that I wish I knew before I started investing, especially my younger self, is to not trip over market downturns. When you first start investing, you're probably going to be looking at your investment accounts each and every day to see if they grew, if they shrunk. And we're playing the long game here, obviously, so I would try as best as you can to stay out of the habit of checking your investments every day, right? Because for some people who aren't as experienced in the market, guys that don't have as much, people that don't have as much skin in the game, they'll be more inclined to panic sell even if the market drops down just a few points. You got to get yourself into the mindset that you're playing the long game and you're making stable money this way. Don't make it a habit to check your investments every day because it'll drive you nuts. Just think to yourself that this is for your future self, so you need to give it plenty of time and plenty of patience to work and grow. Because like I said before, investing is a long game and you need to give it some time to pay off. There's been plenty of people that have had success playing the long game, and if history tells us anything, it's that the long game is proven and it's reliable. So if you're a young guy or a young girl in your late teens or early 20s, I would definitely look into invest. Start investing today, do your own research as always, and be patient. I think that this game rewards patience. But yeah, that's it from me. Appreciate you guys for watching and listening, and I'll see you in the next one.